Edge designations, CFA Level 1, pre-reading financial statement analysis, learning module 2, income statements. We continue onwards with the pre-readings relating to FSA, financial statement analysis, and we now move into the three major bodies of financial information: income statements, balance sheets, and cash flows, and that'll take up learning module 2, 3, and then 4. We start off over here. Income statement is by far the biggest one of the three in terms of content that we've got to get through, and as per usual, we produce for you the learning outcome statements for learning module 2 over here on your front page over here. Let us get ourselves going straight away, okay, with learning module number 2, income statements. Okay, and what you'll notice is we've seen quite a bit of this already in the previous learning module 1, where we introduced the major statements there already: income statement, balance sheets, and cash flow. The first learning outcome statement says describe the components of the income statement as well as alternative presentation formats. The income statement introduction, okay, and it's important something to note about the income statement, okay, as opposed to the balance sheet, which is a look at a point in time. The income statement is a statement of financial results, but what's important over here, over a period of time. So the income statement will reflect a certain period of time, whereas a balance sheet will reflect at a specific point in time. Who uses the income statement? You've got equity analysts and fixed income analysts. Okay. The composition, then the components of the income statement, and obviously the key components are all the incomes that came in for the particular period, as well as the expenses that were incurred over that particular period. And having said that, net income is equal to revenue plus other income plus any other gains that might have been made, less expenses, any other type of expenses, and any losses. And obviously those words are specific to each and every circumstance. Okay, let's have a look over here. And we saw this from the previous learning modules. I'm not going to spend too much time. That's really just an extract of what an income statement looks like. Beginning, of course, with revenue, sales on the top, less cost of sales, gross profit, taking into account some operating information, giving you operating profit, profit before tax, after tax. Then we attribute the profit to the various parties. There may be other controlling parties and some non-controlling interests over there as well, giving us basic and diluted earnings per share. Okay. We continue onwards. Okay. And again, this is all been seen before, and the good news about it, nothing too crazy over here to cause us any kind of headaches. So we move on. Okay. The key elements of the income statement: sales and revenue. Okay. Cost of sales, those are the costs of getting the sales together. Gross profit. Gross profit is obviously what we get when we take revenue or sales less cost of sales equals to our gross profit. Over the page. Top of page 4. Other operating income. There may be some of that. Okay. Operating expenses. Other income. Okay, where does other income come from? Things like income from investments or interest earned on credits or notes extended to customers. You've also got finance costs there as well. That's interest from borrowings. Profit before tax, tax, profit after tax. Okay, and then we've got what we call attributions of profit. We give the profit, we say, well, a certain amount of money was made during the particular period. Okay, and part of it belongs to the shareholders here. We've got other shareholders there, and we show exactly how that breakdown occurs. Okay, and then we say we've got basic and diluted earnings per share. Basic earnings per share just takes earnings over number of shares. Diluted takes into account perhaps that there may be other instruments that may further dilute the earnings per share. Things like convertible securities, convertible debt, or things like convertible pref shares. That will all be handled specifically in the more detailed section in the core readings under income statements. Remember, of course, guys, that we've got two specific readings on income statements. There's one over here in the pre-reads, and then we've got another one again, which we will deal with in the core readings. Okay. When we start to look at the income statement, we can group our expenses by nature. That's also called the cost of sales method. Okay. And expenses are grouped by the nature or the type of expense. Okay. For example, okay, grouping items by nature will be all the depreciation expenses from all the various departments being grouped together. Okay, and that's all called depreciation. We can do it by function as well when expenses are grouped by their functional purpose. Okay, for example, we can break things down into their various departments. Okay, marketing, admin, etc., etc. Both of those options are available. We've got alternative presentation formats for the income statement. Option 1 is allowed by both IFRS and US GAAP. We've got one statement, okay, and that statement is a statement of comprehensive income, including an income statement as well as a statement of other comprehensive income. Remember, other comprehensive income also goes by the fancy name OCI, other comprehensive income, and that is anything that doesn't fit in the normal operations of the business under the income statement, and we'll illustrate what some of the things that go over there, foreign currency reserves and things like that. Option number 2, okay, both IFRS and US GAAP allow it as well. We've got two separate statements, one for the income statement and a separate statement then for other comprehensive income. Option number 3 is for US GAAP only. Okay, we can present an income statement with an additional column, okay, in the statement of change in equity for other comprehensive income, but that's only allowed then under US GAAP. And remember, guys, a big part of the challenge that we have, okay, and we've got to manage over here is the differences, and that's a key component then of financial statement analysis as a section in the CFA syllabus, is we have to manage the differences then between US GAAP and IFRS. So always when you see something like that, note the difference and just keep that in mind, because that is part of the work we have. Okay, income statement can be presented in one of two formats: a single step format, okay, all income and expenses are grouped together, okay, or you can have a multi-step format, a series of subtotals. After each section you total those together to come to net income, another section, another subtotal for gross profit, etc., etc. Okay, moving on to page 6. Okay, describe the general principles of revenue recognition, okay, and calculate revenue given some certain information that we may be given. Okay, certain concepts that relate to revenue recognition. A key one, of course, will be that we work, as we do throughout accounting, we work on a system called accrual. And what does accrual do? Okay, accrual, it's a similar concept a little bit to matching, in a sense is that we match the period to the revenue or to the expense. In other words, for example, if income is received in advance, let's say, for example, I'm a landlord and one of my tenants decides to pay for the next 10 years, well, we will not record all of that income, okay, in the period in which I receive the money, but rather we'll record that income in the period to which it relates as income each year as it relates. Okay, and that's income received in advance. Okay, income received in advance is very obviously then closely linked to accrual, because we can only record things in the period to which they relate. Accrued revenue is a similar concept. Okay, let's say, for example, I've done the service already, okay, but I haven't yet received the money for it. Doesn't matter that you haven't received the money yet for it. What matters is the service has been done. You owed the money should be coming in. Okay, so you can record that then as revenue, even though you don't have cash. So just interesting to see over here, cash is not the key component in terms of my accounting. Okay, we can move over here to revenue recognition. Okay, And here are some of my revenue recognition principles. Revenue recognition for goods sold under IFRS and under US GAAP. IFRS says that the significant risks and rewards of ownership have been transferred. No continuing managerial involvement. In other words, the new owner has taken control. The amount of revenue can be measured reliably. I'm likely to receive the profit. In other words, it's probable that the economic benefits will flow to me. The costs incurred from the transaction can be measured reliably and is normally recognized when delivery occurs or when legal title transfers. Under US GAAP, realized or realizable, okay, it's got to be earned. The SEC gives a little bit of additional revenue recognition requirements. There's evidence of an arrangement between the buyer and the seller. The product has been delivered or the service has already been rendered. We can determine the price, or it is determinable, and the seller is reasonably sure of collecting their money. Okay. What about for services? Again, if you earn revenue via the provision of services, the amount of revenue must be able to be measured reliably. It's probable that the economic benefits will flow. The stage of completion, we can measure how much of the job has been done. The costs incurred plus the cost to complete can be measured reliably as well. What about if I'm earning revenue from things like interest, royalties, dividends? Okay, same story. The amount of the revenue must be able to be measured reliably. It's probable that the economic benefits from the transaction will flow. Okay, and now we move down to page 8, specific revenue recognition applications. Let's have a look. Percentage of completion method, percentage, and you'll see just post to this particular table. We've got lots of little examples for you as well. Okay, method number 1 is percentage of completion. In other words, how much of the process has been completed. That's the amount of revenue that is recognized. Completed contract method. The completed contract method says that revenue, expenses and profit, etc. is only recognized when? Upon completion of the contract. That's why it's called the completed contract method. Okay. Installment method. Okay. Profit that is recognized is equal to the amount of cash that I've collected, okay, times by the total profit as a percentage then of revenue. Again, it works on a percentage or an installment basis. And another interesting method is called the cost recovery method. Okay, revenue is recognized to the extent that costs have been incurred. Okay, in other words, I can only recognize as much revenue as the costs that relates to that particular contract. In other words, no profit will ever be recognized on a contract until it's all completed, because until it's completed, what am I recognizing? Only as much revenue as is required to cover my costs. Everybody comfortable with that? Okay. What about some long-term contracts? Okay. These contracts, typically, where would you find long-term contracts? Things like when you've got construction contracts. Okay. And we've got the different methodologies over here. Okay. When the outcome can be reliably measured, IFRS says use percentage of completion method. US GAAP says percentage of completion method, okay, as well. When the outcome cannot be reliably measured, IFRS says just use cost recovery. In other words, only recognize as much revenue as relates to costs. US GAAP says use the completed contract method. Okay. What if I'm expecting losses? Okay. Everybody would always tell you in accounting, if you are expecting losses, what should you do? Recognize those losses immediately. Okay. Now, I'm not going to spend too much time over here, guys. We have included them in the notes here for you. Here are some examples of the various methods. Let's just take you through quickly. Percentage of completion method. We've shown you how to do that. Nice example for you there. Okay. A cost recovery method, remember, and I'll just show you this one. Let's have a quick look. ABC has a contract to build a building. It's likely to take 3 years. Total revenue we're going to bill on the particular contract is $30 million. Okay. A certain amount of uncertainty exists surrounding the cost of the project. Okay. And at the end of year 1, I've already spent $9 million in costs. End of year 2, I've spent $15 million. End of year 3, I've spent $18 million. Okay. Now, in terms of year 1, and if I'm using the cost recovery method, look how we do that. So my costs for year 1 was how much? $9 million. How much revenue do I take? $9 million. In other words, can you see no profits? I'm just covering my costs. Year 2, same story, because the project is not yet completed. I just cover costs. And year 3, I can recognize as much as I like, because I'm now completed, and now there's a lot more certainty surrounding the project. Now I can recognize the full amount. Okay. Under US GAAP, we recognize revenue then on the completed contract method. Okay. So nothing in year 1, nothing in year 2, and then year 3, then I recognize exactly what is to be recognized on that particular contract. Okay. We move to installment sales. Installment sales, when a company finances the customer's purchase of its products. Okay. And remember, with an installment sale, the customer receives the goods and services up front, takes ownership of them, but then, yes, has to make payments for them over the particular period of time, however long the installment sale is for. Okay. And top of page 11, okay, when the collectability is certain, okay, IFRS says we do the present value of the discounted payments, and we recognize those at the time of the sale. Okay, what's then the difference between the discounted payments and the actual payments that will be received? Okay, that's interest. US GAAP, revenue is recognized at the time of the sale based on what we call normal revenue recognition criteria. Number 2, what if the collectability is not so cannot be reasonably estimated? I'm not 100% sure I'll get everything. IFRS, as per usual, goes for cost recovery. In other words, recognize only what you have already incurred in terms of costs. US GAAP says you can use the installment method. Okay. When the collectability of the contract is highly uncertain, IFRS as well as US GAAP both say go for the cost recovery method. In other words, only recognize the extent of the revenue that you have already incurred in terms of costs. And there's a bit of example for you to take a look over there. Barter transactions. A barter transaction, when the parties exchange goods and service, no cash actually transfers hands. Okay. In terms of IFRS, okay, a barter transaction also needs to be reported on the income statement. Okay, but you've got to be able to determine the fair value of the revenue. Okay, assuming almost as if the transaction happened with unrelated parties, not as if it were related parties. Per US GAAP, okay, we can report income at the fair value if the company has a history of selling products, and a price can easily be determined for the particular barter transactions. Okay, if this is not the case, revenue is reported at the carrying amount of the asset that has been given up or surrendered. Okay, gross and net reporting of revenue. Okay, gross reporting, okay, is we report revenue at each particular level, each sale on its own, each cost of sale on its own. Okay, under US GAAP, the following conditions must be met before we are allowed to use gross reporting. The company is the primary obliger under the contract. They have to act. The company bears the inventory and credit risk. The company can choose its suppliers, and the company has reasonable latitude to establish a price. Net reporting is everything just reported together. Sales with cost of sales, okay, to report them on a net basis. So you're really just going to be showing the net amount. You're not showing sales separately and cost of sales separately. You just show them as one net amount, sales less cost. You just report one line called gross profit. Okay, and there's a little bit of example for you over there. Okay. Over our page 13, several revenue recognition methods as we see that can be used by a company. Of course, you'll need to decide what is the specific criteria and what is specific case relevant to your particular company, okay, and details of it must get reported then in the notes. Some points for an analyst to consider: how aggressive or conservative the firm has been in realizing their revenue. Are the firm's policies reliant on estimates and judgment? Can differences in revenue recognition policies be quantified? Okay. And of course, we know new standards are there as well. Okay. And there is your revenue recognition. Will then follow this new, we've given you a bit of a history up until now. The new standards will show a 5-step approach. Okay. Identify the contract with the customer, identify the performance obligations in the contract, determine the transaction price, allocate the transaction price to the performance obligations in the contract, and recognize the revenue as the entity satisfies their performance obligations. Okay. And there's some nice examples for you. Again, I'm not going to spend too much time on those. But again, as you go through the notes, guys, my suggestion is that you do those. Often it looks nice and easy when you give a quick scan through them. But do try and do them in a bit more detail. That'll be the most amount of value. Okay. And we turn a few pages over here. There's your examples over there. Okay. We move now. We've had a quick look at revenue. We move now to expenses. Okay, describe general principles of expense recognition, specific expense recognition applications, and implication of expense recognition choices for financial analysis. As you can see, this particular learning module on income statement is quite a generic, general type of a reading. We go into a lot more specifics of the income statement when we go through them in the core readings, which we will see. That's going to come up a little bit later on. We start off with accrual basis. What's an accrual basis? We've spoken of the accrual basis many times before. In other words, it makes no difference when cash was received, stroke in our example here for expenses, when cash was paid. Okay, you may well decide, hold on a second, I'd like to prepay my expenses. I've got a lot of cash on hand at the moment. I'd like to prepay my expenses. Okay, well, you're more than welcome to do that. But remember, you still cannot count that as an expense in your current period if the expense relates to next period. Just the fact that you paid it in this period, okay, will result in what we call a prepaid expense, but it will not necessarily go through to the income statement. What only goes through to the income statement is what relates as an expense for the particular period. Okay, and accrued expenses there as well. If I don't pay for my expenses, but they do relate to the current period, okay, still then what would I need to do? I would need to record them as an expense then in my income statement, even though I haven't paid for them in this period. Okay, that's a little bit what we call the matching principle. Period costs. What are period costs? Costs are costs that can be tied directly to the specific period. Okay, and if it's a period cost, these costs will then be put into the specific period. Why? We're linking them then to the matching principle. Okay, and we look over here, the inventory expense recognition. Okay, and generally what we say, inventory, often people used to call it stock, okay, is recognized at cost, the amount paid to purchase the inventories, or if it loses a little bit of its value, at net realizable value. Okay, and again, I'm not going to spend too much time here because we have a whole specific reading on inventory. Okay, and inventory is generally what goes into cost, the amount paid for it, any freight or transportation that is required to get it to its final destination, as well as any other taxes or tariffs. Okay, and there's a little example for you how we arrive then at the cost of inventory. Okay, and there we go. The only thing, of course, you notice over here is we don't include interest in the cost of inventory, but all other costs that are incurred to get that inventory to its final destination, yes, would then be included. Okay, we see over here, guys, and I'm not going to spend a lot of time on this, guys, and the reason I'm not going to is because you'll notice one of our specific readings that we have later on is in fact called inventory. So we've got an entire section coming up specifically then on inventory. So yes, I know inventory, the cost of inventory, okay, is going to be included in my income statement. That's obviously why we have it over here, okay, as a cost of sale. Remember, what does it cost me to make a sale? Well, it costs me the costs of inventory. So inventory, yes, is a very income statement based item, but as I say, we are going to handle that specifically in its own section. Okay, but we'll just talk about it briefly. When I try and calculate the costs of inventory and cost of sales, 4 different ways to calculate the cost of inventory: specific identification methods, average cost method or the weighted average method, first in first out called FIFO, and then last in first out, which is LIFO. And just very briefly, what is the differences between these methods? Specific identification is if you've got normally reserved for very high value items, high end items, but if you can recognize, and you, let's say for example you're selling very fancy cars, well, you can record each car at its specific value, specific identification. Average cost, also called weighted average, I take all the inventory that I've got on hand, all the costs of that particular inventory that I've got on hand, and we just arrive then at a average. First in, first out says, hold on a second, if you have a look over here. Okay, let's just say for example, there's time period 0, time period 1, and time period 2. In time period 1, I bought 10 items of stock. Let's just extend that to time period 2 and 3. Time period 2, I bought 20 items of stock. Everyone comfortable? And in time period 3, okay, I sold, let's say 15 items. Those are my sales. Everybody comfortable? But let's say, for example, these 10 items of stock cost me $10 an item, and these 20 cost me $12 an item. What does FIFO tell you? FIFO says to you, when you now make $15 worth of sales, where did those sales come from? So first in, what came in first? The 10 items came in first. They go out first. Then 20 came in. Those will go. So of my 15 sales, 5 came, sorry, my apologies. 10 comes from here. First in, goes out first in terms of sales, and the remaining 5 will come from there. So yes, we can see, guys, what happened over here. I bought 30 items of inventory. I sold 15. I've got 15 left. Where are those 15 left from? They all come from the 20, don't they? Because the first 10, first in, first out. The next method is last in, first out. In other words, the ones that came in last go out first. So in my example, if I sell 15, where do they come from? They all came from the 20, because the 20 came in last. Last in, go out in terms of sales first. Everybody comfortable with that? And I've got a nice long example for you over here, guys. I'm not spending time on this, guys. As I said, we will do this in the inventory section. Okay, but as you can see over here, we give you nice examples on the specific identification method, the average or the weighted average method. Okay, top of page 18, first in, first out, or the FIFO method, and last in, first out method. We show you that one over there as well. Okay, and here's all your details around it. As I said, guys, I have put it in here, reason being, of course, because it does relate to the income statement, relates, and the specific line item in the income statement is called cost of goods sold or purchases, because I'm purchasing inventory. But again, this is not the place for it. It has its own specific home and place in the inventory section, which is coming up. Okay, so I've given you all of that over there. We then move down to the next big item that you are going to see then on your income statement. And again, an interesting one over here, guys, depreciation. and depreciation relates to property, plant and equipment. And again, this has got its own specific title called long-lived assets, okay, which is the very section that we're going to do just after inventories, which is coming up in as its own specific separate section. Okay, so yeah, that's why again we're going to move through this relatively quickly, knowing full well that there's another big section on it coming up called long-lived assets. Okay, but let's have a brief look at it, notwithstanding because we are here. Per IFRS, property, plant and equipment is measured at cost, okay, or revaluation. When we revalue an asset or show it at its fair value if it's increased in value. But that's only allowed per IFRS, not allowed per US GAAP. US GAAP says we keep all of our assets at the cost model. Again, remembering, of course, guys, that what? This is another difference over here then between IFRS and US GAAP. Okay. Over our page, okay, when I'm looking at depreciation, we look at the following four factors. The cost, the residual value is the value of the asset at the end of its life. Depreciable cost is what it cost me less what it will be worth at the end, and that is the amount that I must depreciate over the life of the asset. Estimated useful life, how long will that item be around for? Okay. And I'm going to show you this in a second. Those are the various methods that we then use to compute our depreciation charge. Okay, straight line, production, and declining or diminishing balance. And let's have a quick look at some of these. A vehicle was purchased for $1,000. Its value or its residual value is $200. Now remember, okay, straight away, what would you tell me? Its depreciable amount is going to be, I bought it for $1,000. It's got a residual value at the end of its life of how much? $200. There is the $800 over there, and that's what I must depreciate over the life of the asset. Again, it'll just depend on which particular method I'm going to use. Straight line method says, hold on a second, there is your cost less residual value. What's its useful life? It's got 5 years, so I will therefore depreciate it over 5 years, $160 every year. Everyone comfortable with that? Okay. There could be times in the life of the asset when its life changes, we can extend its life or perhaps reduce its life. I will then need to adjust the depreciation expense, but as mentioned, I don't want to get into specifics over here. The production method says, well, I'm going to depreciate it based on how much production I can get out of the particular asset. It's got nothing to do with life. It's got nothing to do with years. It's got to do how much it can produce. Okay. And then we've got what we call the declining balance method. The declining methods, okay, provides for massive amounts of depreciation in the early years of the asset's life, and as it gets a bit older, it gets less and less. Okay, and there's a bit of a calculation then for you, and you can see over here the depreciation in year 1, 400, year 2, okay, small amounts, year 3, small amounts. It gets smaller and smaller and smaller. Okay, but again, guys, that is something that we're going to see when we get to the specific examples in the what's called long-lived assets, and that's obviously something we will do when we get to that very specific section over there. Okay, and as I said, I'm not going to spend much more time over here. Okay, all of this will be handled in what we call the long-lived asset section. Amortization expense. What's amortization? Let's say, for example, I've got an intangible asset, goodwill, something like that. Okay, and for example, let's say the goodwill, okay, or the intellectual property, the IP will last for 10 years. I will amortize, I will write that expense then off over the 10-year period. Okay, but again, this is coming up. Same methods as we've seen before. Cost model, you keep it at cost less accumulated depreciation. Or I can revalue it depending if its value changes during its life. Remembering again, of course, guys, this is the big difference between US GAAP and IFRS. No revaluation is allowed per US GAAP. Okay, there we go. So I'm not going to spend time here, guys. Why not? You know it's coming up. Okay, something new. Okay, a bad debt expense. What's a bad debt expense? A bad debt is if I am owed money, I've got an accounts receivable balance, I've got an outstanding loan to a fellow company, a fellow individual, okay, and they don't make payment on that. That's called a bad debt expense. Okay. But what if they haven't actually not paid? They haven't been declared insolvent, but I just think I'm not going to receive that money. What we do is we make a provision or an allowance then for doubtful debts. I debit the doubtful debt expense and I credit a provision, which is called a contra account. A contra account that goes off against my accounts receivable to reduce my accounts receivable because I believe I won't receive that particular money. We've also got a warranty expense. What's a warranty expense? A warranty expense is if you make goods or you sell goods and you're worried that perhaps, or you offer a warranty for a year or 2 years, however long you decide to offer it for, okay, in terms of those goods, okay, that if they don't work or there's breakdowns, the customer can bring them back and you'll service them. Okay, you need to make provision, you need to provide for the probability stroke possibility of customers bringing the goods back to you, and then you will have to incur costs to repair them. That's called a warranty expense. So, and look over there, it's a provision. I provide for it, because remember, when I sell something to somebody with a warranty, I don't know whether or not they will bring it back or whether or not it will fail. Okay, but what we do is we make a provision for it just to make sure that in the event that they do, I have set something aside for that warranty. Okay, implications for financial analysis. Okay, several expense recognition methods that a company can use, and remember, a lot of these expenses, depreciation, provision for doubtful debts, provision for warranties, things like that, are very much dependent upon the management's estimation. Okay, there's a lot of judgment that's involved. Okay, so we ask ourselves the following question as an analyst: how conservative or aggressive is the firm in incurring expenditure? Are the firm's policies resilient? Okay, so reliant, on estimates and judgment. How much of the, and as you can see, those ones that we've just looked at are quite reliant on estimates. Okay, and can the differences in expense recognitions be quantified? For example, can I say, well, if we had done it another way, if we had expensed it over a different period of time, what would that expense have been? And we can look at it from that point of view. Okay, now we have a look over here at operating and non-operating components of an income statement. Okay, operating components of an income statement. Okay, IFRS doesn't specifically define operating activities. US GAAP says that operating components of the firm are those that are generated during the ordinary course of the firm's business, okay, and don't fall into other activities such as investing and financing. Okay, non-operating components, okay, are those that are not generated during the ordinary course of the firm's business, and generally we put those down to investing and financing activities. Okay, IFRS versus US GAAP on the cash flow statement. Okay, and again, we've got a whole new reading coming up on cash flows, but per IFRS, interest and dividends received, okay, you can put them where you like. Not where you like, but you can either put them as operating or investing. Interest or dividends paid can also go to investing or financing. Okay, there's a lot more room to move within IFRS. US GAAP, not so much. Interest and dividends go to operating expenses, okay, and dividends go to financing. So US GAAP is a lot more instructive as to where things need to go. Top of page 25, okay, formulate income statements into common size. Now, what is a common size income statement? A common size is a standardized income statement, okay, because if you don't put it down to a common size, or let's say, for example, something common size would be, let's say we put everything as a percentage of something else. In other words, when I now look at two income statements, it's much easier to analyze, because I'm just looking at, let's say, for example, cost of sales makes up 70% of my revenue. I can compare that across income statements very easily. If I'm looking at two income statements and I'm just looking at their physical numbers, it's not so easy then to make that comparison. Okay. How do we convert an income statement then into a common sized income statement? We make everything a percentage. Now, if you look over here, and generally a percentage of what? And we generally use a percentage of revenue. Why a percentage of revenue? Because remember, it's likely to be the highest number on your income statement, isn't it? Revenue. So if we have a look at the income statements of two companies over here, high and low, okay, the revenue for high is 110,000. That's 100%. Their cost of sales is 60,000. So what would I do? I would put 60,000 over 110,000 and get to 55%. When I look at low, okay, low's revenue, $1.2 million. What does that represent? Same story, 100% of the income statement. Let's look at Lowe's cost of goods sold, 750,000. If I put 750,000 then over 1.2 million, what do I get? Okay, 63%. Now we can make a nice comparison, can't we? We can say, well, take size out of it and we can see what that Lowe's cost of goods sold is relatively high, which then results in a much lower gross profit percentage in relation then to high. And you put everything, all the other items on the income statement, you put them all over what? Revenue, to be able to get a percentage. And now this is called a common size statement. Now because I'm working in percentages, it's become much easier to do the comparisons between the various items. Okay. Up at page 26, evaluate a company's financial performance. Okay. Now looking at the financial ratio side of things, okay, and there is a specific session, guys, on ratios, but here we're referring to ratios that are specific to the income statement. So we look at gross profit margin. What's gross profit margin? That's gross profit over sales. Net profit margin, net profit over sales. Operating profit margin, you got it, operating profit over sales. All of them are over sales. That is the margin that we are looking at. Okay. We have a look over here, and remember we mentioned a little bit earlier on in the notes that there are different formats that one can use for the income statement. Okay, but remember a key component of the income statement was called other comprehensive income. Okay, what is this thing called other comprehensive income? Okay, we have a definition over here per IFRS. Okay, IFRS says it's the change in equity during a period resulting from transactions and other events other than those changes resulting from changes in owner's equity. So my equity's changed, the amount of equity I got in the company, but that didn't come as a result of any kind of issuing of equity or sales of equity. It came about from, we'll see here, under the US GAAP definition, the change in equity or net assets of a business during a period from transactions again and other events. Okay, it includes all changes in equity during a period except from investments made by owners and distributions to owners. So let's have a look over here. I've got closing shareholders equity, okay, and I've got opening, and what is that made up of? When I come to my end year closing equity, what's that made up of? Well, it started off with an opening balance. I made some income hopefully during the year, but remember, declared some dividends, but remember, there's this other item which we like to call other comprehensive income, which also needs to be addressed. Other comprehensive income is what is not normally contained in the income statement. But remember, just because it's not normal operations doesn't mean that it won't impact my equity. It will. I just don't show it on the income statement because it's not an ordinary item that should go on the income statement. But yes, it still has an impact then on my income. Sorry, on my equity. Some other examples of other comprehensive income. Look at some of these and you can see they don't relate specifically to normal or operating income. Foreign currency translation adjustments. unrealized gains and losses on derivative contracts, which we account for as a hedge, unrealized holding gains or losses on a certain category of investment securities, costs of a company's defined benefit and retirement plans. As you can see, these are not normal costs that are relating specifically to normal operations of a company. And there's a little example for you, okay, and you can see again, is my normal net income. And then, I know it may not be the most formal definition for OCI or other comprehensive income, but we call it all the income statement's rubbish dump, in a sense, all stuff that's not really supposed to be there on the income statement. I know that might sound a little bit offensive. I do apologize for that, guys, to those accountants. But yeah, that's typically what goes there. Anything that's not specifically there on the income statement, things like what? Available for sale securities, losses on sale of vehicles, and all good things like that. We give you an example of that over there on top of the page 28. We give you the solution there as well. Okay, everyone come to that. So just remember that there's always going to be two components to an income statement: those items that fall normally part of the income statement, and then we've got those items that are not normally part of the income statement, as they are not part of our normal operations. We call those other comprehensive income. They do impact equity, my final balance of my equity on my balance sheet, but they are not part of my normal income statement. Okay, that then brings us to a close of learning module 2, income statements. As you can see, there is a fair measure of here, particularly things relating to inventory, items related to long-lived assets that we didn't cover in great detail over here. As mentioned, they will be covered specifically in their own sections, which are coming up shortly. There is your summary on page 29, 30, and then 31. Okay. As per usual, guys, we always request of you, when you are done with a particular learning module, always to page back to the beginning of the learning module, just to have a look at the learning outcome statements, and just try and make sure that when you look at these statements over here, that you are familiar with them and that you have taken in exactly what needs to be learned from the particular learning module.